HDFC Bank just released its results for the first quarter of this year, and net profit is at 11,951 crores. This is an increase of 30% versus the same time last year, and it's beaten all analysts' expectations. It seems like the merger with HDFC is starting to pay dividends, and HDFC Bank is back to its winning ways. All of this comes down to just one number. But before we understand that number, let's understand HDFC's results a bit better. Since HDFC Bank makes money from giving out loans, let's see how that performed. Net interest income, which indicates how much money HDFC Bank is making on their loans, is up by 21.1% to nearly 24,000 crores. And net interest margin, which is the margins on the loans that they give out, is stable at 4.3%. Their total balance sheet, which indicates how much they can lend, is also up by 18.6% to 25 lakh crores. This is not surprising. Before we hear the one number that explains their outperformance, let's hear what market expert Mr. Dipan Mehta has to say. He's going to explain why HDFC Bank is such a consistent winner. Let's start with the juggernaut in the room, HDFC Bank, that I mentioned before. One key headline with HDFC Bank is their merger with HDFC, which I guess the original entity. How do you see that playing out, and how do you see HDFC Bank moving forward in the next, maybe year, 2 years, and decade? What does that path forward look like?
No, I think that it's a very strategically right decision to merge both the entities. At the stage in which India is, and at the rate at which the Indian economy is growing, there's going to be a lot of demand for credit. You will require to lend extensively to several sectors. And mind you, Varun, the banking sector, a good banking sector is the foundation for a good economy, for high growth economy. You need strong banks who can lend, who can cut out those big checks, who can sustain retail lending, who in turn sustain real estate and automobiles and the whole wheels of the economy. The grease, it is said, is the banks which move the wheels of the economy. Yeah. So right now, I think the merger between HDFC Bank creates a large balance sheet, a large bank, which is in a position which has the capital adequacy to take big ticket, to give big ticket loans, to expand the retail lending to all corners of the country. So it's a great decision. And partly HDFC Bank has been underperforming because its growth rates had slowed down. Also, size is an issue. And generally, we've seen a compression of their price to earnings, price to book multiple. And that may continue. But when HDFC comes into the fold, I think it'll bring a new sense of energy, because there are, I would say, 60-70% of HDFC customers don't even have an HDFC Bank account.
Right.
So it's going to be great synergy for both these companies. But there could be some teething trouble, technology-related issues, extra provisions which HDFC Bank may have to make for SLR, CRR. It's a complicated thing. It's a complicated merger. But I think give it 6 to 12 months and HDFC Bank will be back to its winning ways and truly outperforming. But HDFC Bank, okay, I've seen banks for 30 years. There are, into my mind, only 2 banks which have stood the test of time, which have never ever been in any NPA mess. They've always had pristine, clean balance sheets. They may have slight ups and downs in the NPA, but by and large, they were never impacted because of any form of NPA. One is HDFC Bank, other is Kotak Mahindra Bank. Okay. Other than that, you look at the history of every bank, SBI, PNB, Axis Bank, ICICI Bank, you name it, they have had a lot of issues with NPS.
But I think HDFC Banks is, I guess their winning formula was set by HDFC in terms of their loan origination, distribution, and recovery, because housing finance is one of the most secure and lucrative forms of consumer finance. I think that's maybe where their pedigree started.
Culture. The culture in HDFC Bank was, first of all, a very high degree of integrity. You see, we had so many, I would say, scandals around banks and bank CEOs. Right? Yes Bank CEO Rana Kapoor was imprisoned. We had Axis Bank, ICICI Bank CEOs also live in a bit of a cloud.
Yeah, I think ICICI Bank is one of those really famous cases as well.
But can you name a single HDFC Bank CEO which have been involved in any whiff of any scandal or anything? No. So it's their corporate governance standards, the high level of integrity, their lending practices, their conservative approach. I think that has stood them in very good stead over time.
Yeah.
And that's the reason, that's the underlying reason why HDFC Bank has performed so well.
Like Mr. Dipan Mehta said, HDFC Bank has never had any problems with bad loans. And that's why the one number that explains their outperformance is the gross NPA. The gross NPA is the total proportion of loans that go bad and never get repaid. HDFC Bank's gross NPA for this quarter was 1.17%, which is best in class. And also, it's down another 10% from the same quarter last year. If you'd like to know more about HDFC Bank results, check out the links in the description. And if you want to know more about investing in banks, check out our podcast. Thanks for watching, and please like, share, and subscribe. Thank you.
This podcast is produced by Elixir Equities Private Limited, a SEBI-registered research analyst. Registration number INA00004787. The information provided in this podcast is for educational and informational purposes only and should not be considered as investment advice. Investment in securities market are subject to market risk. We strongly advise all investors to read all related documents carefully before investing. The securities quoted in this podcast are for illustrative purposes only and are not recommendations for investments. Registration granted by SEBI and certification from NISM in no way guarantees the performance of the intermediary or any providers of any assurance of returns to investors. Dipan Mehta, PaisaSmart, its parent company Elixir Equities Private Limited, or any of its associates do not hold any financial interest of more than 1% in any of the companies or financial assets covered by us. We or our clients, relatives, or associates may have an investment position of less than 1% in the companies covered by us. We have not received any compensation from any of the companies covered by us, and we do not provide any services to them. Our views are based on publicly available information. We strongly advise educators to evaluate market conditions and risks independently before making any investment decisions. This podcast should not be considered as a substitute for professional financial advice. Elixir Equities Private Limited, Dipan Mehta, PaisaSmart, and its associates shall not be held responsible for any financial losses or damages incurred as a result of acting on the information provided herein. This disclaimer is subject to update and modification without notice. We encourage our listeners to regularly review this disclaimer.